Investors, are you curious about Warren Buffett's latest insights on the economy? Wondering why he's sounding cautious about America's economic future? Well, you're in the right place. We're diving deep into Warren Buffett's recent sentiments and what it means for us as investors. But before we jump in, remember to hit that like button below. If you're excited about this discussion, and don't forget to subscribe to our channel, trust me, you won't want to miss our future breakdowns on investment strategies and financial insights. So let's start by addressing the big question on everyone's mind. Why is Warren Buffett expressing caution about America's economy when he's usually optimistic? Buffett's concern revolves around a combination of factors: persistently high inflation, rising interest rates, and a banking crisis. These are causing him to rethink his traditionally bullish stance on the U.S. economy. In fact, he mentioned that Berkshire Hathaway's businesses might not see the same robust earnings as in previous years. But fear not, he's not advising a total market exit. Instead, he's suggesting strategic moves for navigating these economic shifts. Let's break down some of his key recommendations and explore them together. So, Warren Buffett, often hailed as the Oracle of Omaha, recently sounded the alarm bells on the U.S. economy during Berkshire Hathaway's annual meeting. His concerns about the end of an incredible period of growth caught many by surprise, considering his historically optimistic stance. But what's behind this shift in perspective? Buffett's apprehension stems from a combination of factors: rising inflation rates, escalating interest rates, and an ongoing banking crisis. These elements have prompted Buffett and the late Charlie Munger to adopt a more cautious outlook, signaling potentially lower earnings for their company's businesses this year. Now here's the kicker. Buffett isn't advocating a complete withdrawal from the market. Instead, he's offering strategies to help investors navigate these choppy economic waters. One strategy Buffett advocates is diversification with recession-resistant assets. Consider entities like Care Trust, RREIT, CTRE, which owns healthcare properties across the U.S. This type of investment could serve as a hedge against economic downturns, offering stability amidst turbulence. Another avenue to explore is commercial real estate, which historically delivered robust returns. New platforms now allow access to commercial real estate opportunities that were once exclusive. By investing in properties leased by established brands, investors can enjoy stable income even in uncertain times. Buffett's advice also emphasizes diversifying portfolios with foreign stocks. While developed markets face higher recession risks, developing markets like India show promise. Investors can gain exposure through various channels, like ETFs or American Depository Receipts, ADRs, such as HDFC Bank. Buffett's own Berkshire Hathaway boasts substantial cash reserves, favoring U.S. Treasury bills amidst rising interest rates. For retail investors, having a healthy cash balance offers flexibility in uncertain economic climates. Now let's shift gears to Buffett's advocacy for passive investing. Despite his success with individual stock selection, Buffett often advises the majority of investors to embrace passive investing. Buffett's philosophy on passive investing emphasizes simplicity and efficiency. While he's known for picking winning stocks, he recognizes that most individuals lack the time, temperament, or expertise for consistent stock selection. Buffett's praise for index funds traces back to Jack Bogle, who introduced the first index fund for individual investors. These funds aim to mirror market performance, providing cost-effective access to consistent market returns without the hassle of active stock picking. Buffett's recommendation involves dollar-cost averaging, consistently investing fixed amounts at regular intervals into market-tracking index funds. This strategy helps mitigate market timing risks and allows for participation in long-term market growth. However, the key to success in passive investing lies in commitment. Buffett emphasizes that investors need a long-term horizon, 20 to 30 years, to realize the full potential of this strategy. Firstly, Buffett's suggestion to diversify with recession-resistant assets, like Care Trust REIT, CTRE, deserves closer attention. This real estate investment trust owning and operating healthcare properties across the U.S. not only shields against economic downturns, but also offers an attractive 5.56% dividend yield. Secondly, the recommendation to explore commercial real estate opportunities, historically yielding higher returns than the S&P 500 over a 25-year period, opens up avenues for investors. Now, Even the average investor can access institutional quality properties leased by renowned brands, like CVS, Kroger, and Walmart through innovative platforms, ensuring steady income even amidst economic uncertainties. Moreover, Buffett's advocacy for exploring international markets, particularly developing economies like India, shines a light on the potential beyond domestic markets. With economies showing resilience against the impending recession, investors can consider avenues like HDFC Bank, HDB, listed on the NYSE and delivering over 4,300% total return since 2001. This example demonstrates the potential for growth and stability outside the traditional markets. Buffett's preference for holding substantial cash reserves is noteworthy. While Berkshire Hathaway holds an impressive $130 billion, individual investors can adopt similar strategies, especially amidst rising interest rates. Consider creative cash management approaches, such as high-yield savings accounts like Apple's, offering a 4.15% annual percentage yield, outperforming even S&P 500 dividends and 5-year U.S. Treasury bonds. Now let's transit to Buffett's endorsement of passive investing. Let's take a deeper dive into this strategy. While Buffett's knack for selecting winning stocks is commendable, he acknowledges that most investors lack the time, resources, or emotional discipline required for successful stock picking. Buffett's praise for index funds traces back to Jack Bogle's pioneering efforts. These funds, like the Vanguard 500 Index Fund, aim to mirror market performance, offering cost-effective access to consistent market returns without the hassles of active management. This passive approach aligns with Buffett's belief in simplicity and long-term efficiency. Furthermore, the power of dollar-cost averaging cannot be overstated. This strategy, involving consistent investments at regular intervals, mitigates the risks associated with timing the market. By participating in market growth over time, investors stand to benefit from the compounding effect, achieving satisfactory returns. However, the success of passive investing hinges on the investor's commitment to a long-term horizon. Buffett's emphasis on a 20 to 30-year period underscores the need for patience and persistence to reap the full rewards of this strategy. In conclusion, Warren Buffett's invaluable insights offer a roadmap for investors navigating today's economic uncertainties. Whether it's diversification, embracing passive investing, or strategic cash management, his wisdom advocates a prudent, long-term approach in an ever-evolving financial landscape. If you found value in understanding Buffett's strategies and want more in-depth investment analysis and insights, please show your support by liking this video and subscribing to our channel for regular updates on investment strategies. Additionally, check out the description below for resources on how to generate passive income through various investment avenues. Thank you for joining us today. Your engagement and feedback are invaluable to us. Remember, informed investing is empowering, and we're here to guide you on this financial journey. Stay tuned for our upcoming videos, and until next time, happy investing.